What are mergers and acquisitions in 15 seconds? Mergers and acquisitions involve the combination of companies. In the case of a merger, two companies will combine to form a new company. In the case of an acquisition, a company will take over another company. What is venture capital in 15 seconds? Let's say a startup wants to become a successful business. In order to do that, they need money, and this money is called venture capital, and that comes from investors like venture capitalists and angel investors. What's a derivative in 60 seconds? A derivative is a financial contract linked to the performance of an underlying asset or group of assets. And the thing about a derivative is you don't actually have to own the underlying asset or group of assets to form the contract. So for example, let's say we have party A and party B, and they sign a contract, which is the derivative. And the contract says if the gold price rises, A pays B. But if the gold price falls, B pays A. And this derivative is derived from the price of gold, which is the underlying asset. And neither A nor B actually have to own the gold to form the contract. You may be wondering, why would people form a contract like this? The reasons could vary. It could be as simple as making money, but generally it's to ensure something you don't own because it could affect you in a different way. What's a credit default swap or CDS in 60 seconds? So let's say we have a lender who lends money to a borrower, but the lender is worried if the borrower can actually pay back the loan. So what the lender can do is get a credit default swap or CDS. And what a credit default swap is a financial contract that requires whoever is offering it to step in and pay back the loan in the case that the borrower defaults and fails to pay back the loan. And in exchange for this, the lender agrees to pay whoever is offering the CDS. More often than not, this is an ongoing payment and usually not a single payment. But in exchange, the lender gets an insurance policy in case the borrower defaults and fails to pay back the loan. What is an IPO in 60 seconds? IPO stands for Initial Public Offering, and you'll see why it's named that way very soon. So let's say we have a company and it wants to expand. In order to expand, it needs money, and it gets that from investors. So let's say the company starts off as small and privately owned, like all companies do, and it wants more money to become a bigger company and to expand. So what it can do is pick a public stock exchange or stock market and offer more shares to the public, which is why it's called a public offering. And since it's the first time it's doing this, it's called an initial public offering. So this public offering of more shares of the company to the public via the stock market is why it's called an IPO. And since now the company is bigger, there will be more shares held by more people, but the company is also bigger and you can buy and sell these shares in the stock market. What is investment banking in 15 seconds? It's simpler than you think. It's basically to raise capital or money for businesses and organizations, and they do this by helping them go through IPOs or underwriting new debt or securities or marketing their securities or facilitating mergers and What is merchant banking in 15 seconds? Merchant banks basically help raise funds for corporations and high net worth individuals. They also do financial advising, and the U.S. definition of merchant banking is more focused on international finance. What is private banking in 15 seconds? It's basically a bank for high net worth individuals. Most people go to a normal bank, they go to a private bank. They're more catered to. They have extra services like investing in portfolio management, wealth management, and help with wealth transfer. What's a trust fund in 60 seconds? A trust fund is a popular way to transfer wealth. There are three types of individuals involved with trust funds. There's the grantor, the trustee, and the beneficiary. The grantor puts in the money and assets into the trust fund, which can hold all types of assets like cash, stocks, real estate, businesses, gold, silver, etc. The trustee is responsible for managing the trust fund and growing the assets over time, usually through investment. Depending on the terms and conditions the grantor sets, the proceeds of the trust fund are distributed to the beneficiary. So there are two types of trust funds. There are revocable funds and irrevocable funds. For revocable trust funds, the grantor may change the terms and conditions, and he or she usually has more control. For irrevocable trust funds, it's very difficult for the terms and conditions to be changed. What's a hedge fund in 60 seconds? A hedge fund is formed when a group of investors pool their money to form a single investment fund. The hedge fund manager is usually one of these investors, and more often than not, he usually has a big chunk of money in the hedge fund, which gives him more credibility and makes the other investors trust him more because he has a bigger stake. So a hedge fund can invest in all types of different assets like stocks, real estate, private equity, commodities, etc. But most hedge funds have a specific investment strategy, and investors usually pick the hedge fund that fits their investment philosophy or because they like the hedge fund manager and trust him. So hedge funds are usually only accessible to accredited investors who make large initial minimum investments. So all these investors are big investors, and that allows them to generate high returns and face less regulation that protects smaller investors. What's a mutual fund in 60 seconds? A mutual fund is a type of investment fund headed by a portfolio manager or money manager, and it invests in different types of assets like stocks, bonds, commodities, etc. It gets its funds from a lot of different investors who put the money into the mutual fund so that the manager can manage it for them and grow their wealth. And it's for small investors, so it's not like a hedge fund. And there's a lot of different investors putting small amounts of money together, and the manager pools the money and invests in different securities or assets. And it's much more regulated than hedge funds because the government wants to protect the small investors. So you can't do more risky activities that hedge funds do, which is why hedge funds, although they're more risky, can generate higher returns. But mutual funds are usually safer, but don't usually generate high returns. What's the difference between investment banking and merchant banking in 60 seconds? Both investment banking and merchant banking involve the raising of capital or money for businesses and organizations. In terms of the differences, investment banking focuses on large corporations and organizations, while merchant banking focuses on small to medium sized businesses and organizations. Also, investment banking specializes in IPOs and mergers and acquisitions, while merchant banking specializes in international finance.